Hello guys and welcome again to my accounting YouTube channel where I translate difficult accounting topics to a storytelling version sort of. So let's continue enumerating the possible questions related to loans receivable accounting. So in the past episode, we have already talked about these first 5 possible questions related to measurement of loans receivable. And we also talked about these 2 accounting or recording related questions. So in this video, we will start by talking about presentation-related questions. So stay tuned. Again, possible questions 8 and 9 are related to presentation of loans receivable account balance. So these questions are, what are the current and the non-current portion of the loans receivable balance? Well, if we apply that in this problem, for example, if you will be asked what is the current and non-current portion of the loans receivable at the end of year 1, what you should do is first, focus on the loans receivable balance at the end of year 1. Okay? And then, compare it with the balance 1 year after, which is the end of year 2. Okay? Now, if the balance decreased, then the difference is what do we call as the current portion of the receivable. And the balance at the end of year 2 is automatically considered the non-current portion. Okay? So, in this particular problem, we have a loans receivable balance of 4,818,304 at the end of year 1. Now, if we compare it with the balance in year 2, you will realize that the receivable became bigger. So, as a conclusion, there is no current portion of the receivable. Okay? Because again, current receivables are receivables which are settled within 1 year or less. So that's the general or the default. So, since in year 2, that's after 12 months from year 1, the balance became bigger, that means nothing was settled 12 months after the end of year 1. Therefore, there is no current portion. Okay? So the whole balance at the end of year 1, the whole receivable, is considered non-current. Now, let me tell you one thing. If the principal is to be paid only once at the end of the maturity term, like this problem, please expect that there are no current portions on the receivable or liability balances during the earlier years of the term. And you need to remember that. But if the principal is to be paid multiple times at multiple dates, then expect that the balances at the end of each year consists of current and non-current portions. Okay? So that's a shortcut, and I hope that's clear. And I hope that fact saves you time in answering questions in the future. So, the next set of questions are related to impairment. And actually, question number 10 is what is the impairment loss amount? And remember, the impairment loss is just the difference between the old receivable, like this one here, and the present value of the new promised payment, just like this one. Okay? And after that, you need to multiply it by the weight or probability of suffering from the credit loss. So, that fact is also true even if we talk about stage 2 and stage 3 of the general approach of the expected credit loss model. Because those 2 stages records lifetime credit losses. I hope you can still remember that. The only one that's different is the stage 1. Because, again, if you remembered, stage 1 only considers expected credit losses for 12 months. Okay? So, that's it for question number 10. Next is we have question number 11, which is what are the journal entries to record the impairment loss? Well, again, that is as simple as this one. You can just have debit impairment loss, just like this, and then credit loans receivable, or you can choose allowance for impairment losses account. And that's it. Now, let's have question number 12. What are the journal entries after recognition of impairment? Well, the journal entries can be as simple as this here. It's just debit loans receivable or allowance for impairment and then credit interest income. That is if the debtor did not promise to pay something in that year. Okay? Like in this example, the 4 million will only be paid at the end of the term. Because if there are payments before the end of the term, like for example, BBM the debtor in this problem promised to pay, aside from the 4 million, BBM promised to pay reduced interest payments. So if that's the case, you have to debit cash for the payment and then credit interest income. That's for sure. Okay? And the balancing figure, it's debit or credit loans receivable. Yes, the loans receivable can be debited or credited. The loans receivable will be debited if the receivable increased, just like in this example. But sometimes it will be credited because sometimes it is decreased due to payment of the debtor. Okay? So once again, the entries subsequent to impairment can be as simple as this: debit loans receivable or allowance for impairment, and then credit interest income, if the debtor will not pay anything during that year. But if the debtor promised to pay something in that year, then debit cash for the payment, and then credit interest income. And then the balancing figure will be debit or credit loans receivable account. Okay? So once again, let's talk about the other possible questions in the next episode to keep this video short. And if you learned, please click like, subscribe, and hit the notification bell to be updated on my next videos. And remember, there is always an easy way to understand complicated topics, and you need to find that. So again, thank you, and see you on my next video.